Hey, this is Ryan with ourdebtfreelives.com. I've gotten quite a few questions about, how much do I need to start investing? When should I start investing? So in this video, we're going to go over some examples that'll show you just how big of an impact even small contributions can have on your portfolio. And if you're planning for retirement, the sooner you can start saving, the better.
So I'm going to use this Excel file that I've built out, and you can find it on our website. There's a link below that you can download it. So the first thing I'm going to do is just explain a little bit about how this works. So over here, you'll see information. So it'll ask for your current age, the market return. Now you can really enter anything in here. I'm going to put it at 10%. And then the initial investment. Now this is going to be if you have any investments currently. So let's say you have a 401k and you have a balance of 20,000. You would go ahead and enter that 20,000 in on there. And then over here we have the contribution occurrence. So this allows you to go through. You can select. So for these scenarios down here, if you want to contribute daily, weekly, bi-weekly, monthly, annually, you can do that just by selecting one of these. And then if we come down here, so you can see with scenario one, this will affect this one. So we have the starting date, and that's going to be the date that you start contributing. And in this example, I'm going to show you how big of an impact starting early can have on your portfolio. So we're going to say that you're 20 years old and your initial investment is 0, your market return is 10, and then contributions, we're going to use daily. So you'll notice down here, if I change it to monthly, this will update. And the contribution amount, what that does is if you put, let's say, $10 in there, that'll be your monthly contribution. So you'll see 120 for the total for the year. But if we change that to daily, so if you contribute $10 a day, your total contribution would be $36.50. So we're going to show an example of where an individual that starts at the age of 20 invests $5 a day. And then we have this over here, this first scenario. So we have the beginning balance at the age of 20. We have the annual contribution, and then the annualized return, which is that 10%, and then the ending balance. And the ending balance is going to be a sum of these three right here. And so in this other example, we're going to say that you wait until you're 35 and you contribute the same $5. So if we go over here, we can see the comparison of the two. So right here, we haven't contributed anything. Right now, if we look at the balance at age 34, it's 63,000. And then when we jump, if we look at the age of 60, you hit right around $1 million. So that small investment of just $5 a day, by starting when you're 20 instead of 35, you could see that the balance, you have $1 million over here. But by starting an extra 15 years later, it's 220,000. So it's a pretty big difference on there. And one of the other things to know, even if we go through and we contribute, so we go from 1,800 a year to 5,500 a year, but again, still starting at the age of 35. So even with you investing an extra about $3,700 over here, your balance on the second scenario will actually never surpass the first scenario. So if you're thinking, I can only contribute $5 a day, you can see just how big of an impact you could have a portfolio of close to $1 million. Again, given that 10% market return at the age of 60, 61. And this will allow you to quickly go through and try a number of different what if scenarios. So you could even say, what if I just put in $250 a day and left, let's say that at 15. You could look at the age of 60, you'd have about $500,000 over here, even with just contributing $2.50 a day. Again, it's just that impact that starting early has. And again, those initial first years, the more you can contribute, the better. So another example, we could leave this at $5. And let's say you decided to wait until you're 45 to start contributing, but you're contributing 10 times as much. So instead of 1,800, it's 18,000 a year. If you come down here, again, you can see that the ending balance on the second scenario, so you can see even though you're contributing 10 times as much, the ending portfolio balance is still going to be higher in scenario one. So if we look at the total contributions made for this first scenario, it's 91,000. And then over here, you would have put in close to 500,000, and your portfolio would still be less than it would be with scenario one. Again, that very important thing is time value of money. Even if you can contribute a little bit now and slowly progressively start to increase that, again, it's better to start now than push it off and wait. So you could go over here and play around with it. And again, like I said, this is going to be on our website. And this is just a simple Excel file that I created. And we do have some more sophisticated Excel-based
tools to help you with early retirement or financial freedom.
And thank you for watching our video. If you'd like to learn more about financial freedom or planning for retirement, beginning investing, anything such as that, you can check out our website. Also, please subscribe if you do find this video helpful. And we'll be uploading a lot of new videos for individuals that are just looking to start investing, or those individuals that have already started but are needing a little extra guidance. Also, intermediate investors, to help you manage your portfolio and also your retirement plan. And thank you for watching.